Hey folks, it has been another week of hellscape across the stock market. Things that look fundamentally amazing are absolutely collapsing. We went from banks to major tech companies. We'll discuss a little bit about that, but obviously there's value plays that are setting up across the market, but people don't want to take advantage of these dip buy opportunities because why? Why when you can put it into a high interest savings account, a GIC or a bond at 5%? But for someone like me, a young dude that wants to outperform the market, this is the window of opportunity. And we're going to be discussing that in full transparency as I reveal to you my $418,000 Canadian dividend stock portfolio. Well, we also analyze the performance of each of my investment accounts, from my tax advantaged accounts, the TFSA, RRSP, my regular accounts, my corporate accounts. This will give you a full idea into the performance and what we currently sit in for March of 2023. Because I'm telling you, I'm down tens of thousands of dollars. This has not been a fun market. I feel like I'm throwing money onto a trash fire and it never ceases to stop. But hey, that's the reality of the market sometimes. And let's get into this. Before we talk about the portfolio, we should talk about these companies this week. It's been a horrific week, guys. I'm honestly kind of terrified. I've never experienced a market like this where the likes of Block, a competitor to Shopify, Jack Dorsey, the guy that created Twitter, is now running this company and he's running it into the toilet. The stock's down about 20% this week, but it's actually still a $36 billion market cap company, which is astoundingly huge. And the Hindenburg Report, this research group, if you've never heard of them, they took down freaking Nikola, and now Trevor Milton, the CEO of Nikola, is going to be going to jail for fraud. And they're claiming that there's a lot of fraud going on in Block. They're claiming that their Cash App, a huge transactional platform similar to PayPal, has a lot of fraudulent transactions going on, and they're not doing a good job at preventing it. They're saying that 40 to 70% of the people on Square, their user growth is actually fake. They're bots. They don't exist from insiders. This is really bad, and it's taking the company down with it. So, that's wild. We've got more allegations against Coinbase, claiming that there's more security charges that could be laid by the SEC. That's tanking Coinbase this week. And all of this kind of comes into the fundamental conversation of the divergence between stability and kind of recession-proof investments. You'd think with the recession-proof investments, that's where everyone's going to go. Your Procter & Gamble's, your toothpaste companies that have been around for 100 years. But in markets like this, when we're talking about Cathie Wood and the ARKK Innovation that's focused more toward the future, these companies haven't proven themselves. They haven't had 100 years of stability, so they come with absurd volatility, right? And we can see that in our holdings, and people are still buying this. I think it's prudent to take advantage of some of these companies because, we're talking about revolutions in these industries, like Tesla taking over the auto industry, but you got Coinbase, you got things like Square in here, and this is going to come with this kind of risk. And it's going to be neat to see how they kind of come out on the other side of this. But from a fundamental basis, I'm still looking at those foundational companies, right? I have some growth plays very mitigated in my portfolio the way they should be. But when we're talking about future potential, we're starting to see it in value plays, not just future growth plays. And I've been talking about that with the banking sector. And obviously the banks are continuing to sell off. Royal Bank's down, bringing down VDY with it. VDY is getting trashed, my broader base Canadian dividend ETF. But I'm still analyzing these REITs. Look at RioCan now, down back below $20 a share, well below its net asset value, a huge buying opportunity at 5.5% dividend. Realty Income, very similar on the US side of the border, a mega cap REIT worth $40 billion for the first time in a while is paying well over 5%. I might even buy this in my RRSP because God, it's a rarity you see a value in stocks like this. So there's obviously still risk, and there could be a lot of potential downside because obviously REITs, especially in the 2008 financial crisis, they dropped 40%, but I see this trading for well at fair value, reasonable levels. And I don't think I'd be doing too wrong buying it here. But putting that aside, guys, let's just take a look at where the portfolio sits this week coming into the latter half of March of 2023. And then we'll take a look at the performance of each one of my individual brokerage accounts. But first and foremost, the portfolio is down about $9,000 from the cost average basis. Not that bad, about 2.3%. We're sitting around $389,000. I would really like to get back over that $400K mark. We take the cash position into consideration. We're worth still around $420. I'd be down way more than that if I wasn't shoveling so much cash into the market when things dip. So, obviously we're all just trying to take advantage here when we can. I'm expecting some super fat dividend checks this month. I've already received $627 from VDY, but in the next week or two, we should be getting the SCHD check, which they just reallocated their top 10 holdings. I did a video on that. Go check it out from yesterday or a couple days ago. We also got VOO that should be paying out in the next couple of weeks. So I should have the largest dividends I've ever received for the month of March. So So very exciting stuff coming up. Consider subscribing for those updates. And if you want to support the channel, you like my portfolio overview, I do always recommend going to portfoliospreadsheet.com. You buy one tracker, you get one for each platform. I also have specific finance trackers that are sold separately for keeping track of your FIRE journey, your income, and your expenses. And you can use coupon code dividends. You'll get 30% off. I definitely appreciate it. They're my own personal trackers. But putting that aside as well, let's talk about the individual accounts. I haven't updated you guys on a little while coming into March, but I'm still kind of astounded by how well the accounts have been performing since the big adjustment I did back in the spring of last year, moving more toward dividend-focused index funds and ETFs. But we can see my TFSA is up 151% since I started it in June of 2017, which is almost doubling the performance of the NASDAQ, which is only up 84% in the same time frame. S&P is only up 64%. Taking a look at my managed cash account, my longest standing account that I started in 2014, this sucker's up 307%. It's had a wicked dip because of the volatility through 2022, but we're still well doubling the performance, or roughly just over doubling the NASDAQ that's only up 150%. Keep in mind, it goes all the way back to September of 2014. I've been investing for a while. Feels like it's been a while at this point. We've got my RRSP, my best performing account, hands down. I'm waiting to top this one up. I might buy O Realty Income in here along with a bit more SCHD. I'm kind of getting tempted because these dividend plays, they're just looking so intriguing, man. But this account's up 253% since August of 2019 because I mostly bought Tesla. I sold Tesla off. I bought SCHD, and this account has been crushing it ever since. It's kind of astounding to think that in the same time frame, the NASDAQ's only up 40%. And then finally, we do have my corporate account, which is probably more reminiscent to newer investors because I only started this in May of 2021, right before the market tanked. And that's represented by the blue line. And we can see it because I held Facebook and it was rallying so much here. And then all of a sudden, everything tanked. I sold Facebook sometime around spring, similar time to last year. And that proved to be pretty prudent because we're actually still outperforming the S&P 500 and the NASDAQ just barely. Obviously, it's we're not making any money here, but my God, at least we're surviving this market calamity. So that's kind of where the entire portfolios are sitting coming into March. And I don't know what it's going to look like moving forward, but I'm having a hard time holding back from buying some individual investments because I'm not talking tech. Like outside of Taiwan Semiconductors, I don't find tech that appealing here. I don't find Apple or Microsoft or these companies that still trade for premium values. But what I do see is really good dividend payers and value players out there trading at really discounted areas, especially in the REITs like Ryokan and O. Now they're going to be hindered by the interest rates environment, but I think they've priced a lot of that in. And if they go down any farther from here, it just doesn't make feasible sense. These are very robust companies. They have really good debt to asset ratios. I mean, even Stag Industrial, a lot of these REITs. So I'm going to be keeping an eye on them. Just consider subscribing because I'll let you know when I do decide to buy them. But man, it's such a weird market. So I'm obviously going to keep cost averaging into the broader based ETFs. Maybe start buying VCE here as well. But you can't help but see value in dividends. And when you're looking for cash flow and early retirement, I think this is the window of opportunity to perhaps start taking advantage. But what are you buying? I'd love to know in that comment section below.